Andy and Lauren have a combined gross income of $88,000 a year. They estimate the property taxes to be $800 per year and insurance would be $1,150 per year. They have one car payment of $295 a month and a combined student loan payment of $425 per month. Express your answers to the nearest cent. So in part A, we're going to use the total expense ratio in your packet to determine how much a monthly mortgage they can afford. Now, if you recall, we're going to take 36% times their monthly gross. We're going to subtract monthly housing. So there's the insurance, taxes, that kind of thing, and then other monthly payments. So, in looking at our numbers, 0.36, now we know their yearly gross. So we will take 88,000, divide it by 12 to get our monthly gross, and then multiply by 0.36. Their monthly housing, well, the insurance is $800 a year, and the property tax are $800 a year. Insurance is $1,150 a year. So we're going to have to divide that by 12 also. And then we've got $295 for a car and $425 for student loans. So we got to take those together and then subtract that. So when you do each piece individually, so my first monthly gross, when I took 0.36 and I multiplied by 88,000 divided by 12, I ended up with approximately, well, not approximately, I ended up with 2,640. Then when I took my 800 plus 1150 and I divided by 12, I ended up with $162.50. And when I took my 295 plus 425, I ended up with $720. So when I actually did that subtraction, I figured out that Andy and Lauren could afford a $1,757.50 payment each month. Now, just because the bank says that's what you can afford isn't necessarily true. Remember, you got to be able to do other things besides make a house payment, like, I don't know, eat. Okay, now, so we're going to assume we're going to keep the $1,757.50 for our monthly payment. And Andy and Lauren want a 15-year mortgage and can get a fixed rate of 5.9%. So use the Excel's PV function, present value, to determine the value of the house they can afford. Okay, so in Excel, we would type PV, and we start with the rate. So we know our rate is 5.9%, but that's an APR, right, an annual percentage rate. So we're going to have to divide that by 12 to make that monthly. In the middle, it's the number of payments. Well, they're going to make 12 payments a year, and we're going to multiply that by the 15-year mortgage. And then at the end comes the monthly payment. So $1,757.50. Now, if you type that into Excel, Excel's going to spit out at you $209,609.53. So if Andy and Lauren want a 15-year mortgage at 5.9%, and they're going to make a house payment of $1,757.50 a month, they can buy a $209,609.53 house, which is a lot. They might want to go down, maybe, I don't know, a little bit, so that they're not spending the whole $1,757.50. But that's my personal opinion. So Andy and Lauren, congratulations, go buy a house.